Welcome to the Balance Blueprints podcast, where we discuss the optimal techniques for finances and health, and then break it down to create an individualized and balanced plan. I'm your host, Justin Gaines, here with my co-host, John Prober. In this episode, John and I discuss how to prepare for the worst day of your life, and if the plan is structured properly, how to set your kids up for a bright financial future. Thank you for listening. We hope you enjoy. So I guess I'll summarize the basic uses of life insurance, and then I'm going to rank them by what I perceive as in the industry most understood to least understood. And then we'll go through what I consider as one of the least understood uses of life insurance. But I would say the bottom three are probably equally not understood by most individuals in the insurance professional. And that's mostly because in order to get your life insurance license, it varies by state. But in New York, where we are, you take a 40-hour class and you can take it online, and that gets you your life, accident, and health. So it allows you to sell life insurance, accident insurance, and health insurance. If you just wanted to sell life insurance, it's a 20-hour course.
I didn't know it was that quick.
Yeah, you take a 20-hour course, pass the course, then you have to go and take a state test, pass the state test. Now you're licensed and you can go sell life insurance. So you wonder why the industry as a whole has a negative stigma around it. It's because you have all these people who are running around with licenses that don't have depth of knowledge. They just have a license to sell. And generally speaking, commissions on a life insurance policy, it varies on what type of life insurance it is, but they can be anywhere from 50% to 110% of the first year premium.
Yeah.
So it's an area where there's a high need for it. If I firmly believe that if everybody understood life insurance, they would own life insurance, because almost every individual has some sort of need for it. It might be a small need, it might be a large need, but just about every single individual has some need for life insurance. Problem is you have these people who get these licenses and then they prey on that and they just try and sell these massive policies. And then people think life insurance is garbage because they've seen a garbage life insurance policy. They've seen it used improperly. And so it's not that life insurance is trash. It's just that you have non-professionals selling a product that they don't understand in scenarios that they don't understand in order to make the most amount of money. And you end up with trash products out there because it's not the product that's trash. It's the application of the product that's trash.
Yeah. I mean, I'll say that I have a better understanding and I see it from their viewpoint now, because like the people at the big name places that kind of just sell policies, with how hard it is to get maybe a job that pays decent, I didn't know it was that easy to get into. So it's kind of a shame. I'm not justifying what they're doing at all, but now it completely makes sense that these people basically just take a course so then they can make a large amount of money. They don't really care about the person.
Well, and the other issue is that, so the number one problem that you have in the insurance industry, the number one problem that I'm always trying to solve for my business is talking to enough people. Now, we take a very educational approach. So the number of meetings I can have in a day is limited because of that, because I'm going to take as much time as I need to educate you on the topics, make sure you understand what we're doing, make sure you see how it fits into your plan, and also have it where if you go and shop this around or you go talk to somebody else, you can educate other people, but you also, if you were talking about your plan with a family member or with a spouse, if the spouse isn't in the meeting with me, I would like the spouse to be there. But if you're talking about your plan with somebody, I want you to be able to say why you're doing what you're doing. I don't want you to be like, oh yeah, I just bought this policy, and then somebody gives you an objection to it, and you're like, I never talked about that. I don't know about that. And you have a good point. That's an interesting thing that we didn't talk about. I want to have that conversation. I'll even tell clients, when you're talking to somebody who doesn't understand this or doesn't like life insurance, this is going to be the pushback that they're going to give you, whatever it may be, and just explain why they're right and why they're wrong, and then why I'm recommending what I'm recommending and where that's beneficial and where the drawbacks are and what you're giving up in order to do these things. Because at the end of the day, no matter what financial plan you're using, there's going to be drawbacks. And I always say, I'm the defensive coordinator of the financial planning. So mine isn't the most risky, and it also doesn't have the highest rates of return. It's going to position you so that you can take more risk in other areas because you have a conservative nest egg that's allowing you to take risk in other areas. Right. But to get to the list, to not draw on this, but to get to the list, I would say the two most common and easily understood uses of life insurance are getting it for debt repayment and income replacement. So that's, you go and get a mortgage. It's a 30-year mortgage on a $200,000 house. You go and buy a $200,000 term policy for 30 years, you and whoever you're buying with. And that way, if one of you passes away, that term policy gives the other person, the beneficiary, the $200,000 to then go and pay off the mortgage. And now they don't have to worry about paying that mortgage. Mm-hmm. The other one, income replacement, you have somebody who is, say you and your spouse, you make $50,000 a year, or you and your significant other that's living together, if you're both relying on the joint income, this is where income replacement becomes key. Or if you have kids that are relying on your income, that's another scenario. Effectively, if you have dependents on your tax return, you should have income replacement through life insurance, disability, those types of policies. What it does is you look at how many more working years do they have left, and then take a multiple of their current income in order to replace that income for the remainder of those working years. Mm-hmm. What you wouldn't do is so take somebody who's 30. Realistically, they're probably going to work till 65 or 70. So call it 35 years. If you take 35 years at $50,000 of income, that's $1.75 million. But that's not how much you need. You do not need $1.75 million to replace this income. Because one, if your income's at $50,000, a portion of that's taxed. Mm-hmm. And the other piece is that you can take this large nest egg, invest it into conservative areas that have, low risk, but also lower rates of return, and that's going to kick out interest. And so with principal and interest, you can replace the income. So generally speaking, you're going to look at somewhere between 10 and 20 times whatever your income is. That allows income replacement. So those two, very well understood, the most common sales for those, very quick, very easy. Now, the last three are less understood scenarios, and they take a lot more explaining. So I'm going to just list these ones off, and then our podcast is going to be on the third one.
Okay.
So estate planning, using life insurance for estate planning. So that's going to be, managing your tax load, managing transferring of assets to the next generation, creating a legacy for yourself, any of those types of things. Using it in business planning. This can be buy-sell agreements, making sure that you're able to, if one of you passes away, the business can continue. Similar to income replacement, but there's tons of scenarios there. You can also use it for employee retention for your key individuals, or also your high performers. If you need to create a financial incentive package, but you don't want to offer it to everybody, there's also ways to do that with life insurance for business planning purposes. But then what I would say is probably the most misunderstood or not understood at all scenario is juvenile life insurance policies. So juvenile life insurance just means life insurance on somebody who is under the age of 18. Generally speaking, you can get life insurance on somebody from ages 6 months to whenever. So, 6 months is really when it starts, and then you can go up from there. And those are juvenile policies. The reason why I think they're most misunderstood is because most people understand debt repayment and income replacement, which is if you have dependents, you need these types of life insurance.
Right.
Or if you're trying to pass things on to a family member, and even if they're not a dependent and you want the house to move debt free, you need that debt repayment so that it's paid off and then they get the house. There's no debt on it. Mm-hmm. With a juvenile doesn't have any dependents. They are the dependent.
Yeah.
So why would somebody need that life insurance? Can you think of any reasons why somebody under the age of 18 would need life insurance?
I would imagine a common one would be for the expenses of the funeral. Obviously, I mean, I'm sure that people may have money saved up, but you probably don't. You're not expecting that.
Right. You're not thinking about it. And I would say that's the most common answer for juvenile insurance.
Yeah.
But I would say that is, and you kind of touched on it, you might have money for that. You might have money set aside. It's also one of those things that if somebody under the age of 18 were to pass away, you would find a way to take care of those funeral expenses. No matter what it was, you would make it happen, because as a parent, you're not going to allow your child to not get the proper funeral services. You're gonna take sacrifices in whatever way possible. Now, we want to make it so that you can not have to worry about that. But more importantly, if you try and put your mind as a parent who's just lost a child, how quickly are you going to go back to work?
It's not even imaginable. Like, really, I have no idea how long it would take to recover from something like that.
Yeah, I mean, you're talking. I mean, your work, realistically, your work, depending on how large of a business you work for, family-owned business or large corporation, you might be given. You're going to have your sick days, vacation days that you can use. Past that, they may be generous enough to pay you for some time away. They may not. The most generous I've seen is, they might pay you for 4 extra weeks of you working from home or doing.
Seems reasonable. Yeah.
But that's only a month.
Yeah.
So that's a month. And say you had 4 weeks. Just say it happens early in the year and you haven't taken any vacation or any of that sort of stuff. You have 4 weeks saved up. So now you have 2 months to try and to mourn the loss and try and heal. And the reality is 2 months is not enough time to lose somebody and try and heal. You're still going to be struggling emotionally, mentally. And so what I use juvenile policies for is, yes, we want some carved away for funeral expense. But my primary concern with juvenile life insurance is making it so that the policy is large enough so that the parents do not have to work for a year at minimum.
Oh.
So if the household income is $100,000, then we would take out $100,000 on each one of the children in whole life insurance.
Mm-hmm.
And that's because, one, the cost is going to be minimal. You're talking $100,000 on, and honestly, it doesn't really matter if there's 6 months or 17 years. The price isn't going to change because you're paying a minimum premium policy.
Mm-hmm.
$100,000, you're looking at somewhere between $300 and $500 a year, depending on, age, pre-existing health conditions, all that sort of stuff. But very inexpensive cost for what you're getting. It allows the parents to not have to go to work for a year, and they can just focus on healing, recovering, maintaining the family unit. Because if there's also siblings, you also have to be there as a support network for the sibling that just lost one of their siblings. You're going through this very tough scenario where all of us hope we never have to experience this.
Yeah.
But if that day ever comes, you need to be able to not have to go to work. And so what the juvenile policy is trying to do is, in that scenario, you have massive amount of grief, massive amount of stress. What we want to do is we want to remove any and all financial burdens, stress, and obligations.
Mm-hmm.
If we can remove all of that, we no longer have to worry about anything other than grieving, mourning, and healing.
Yeah. Yeah, they say, I think I've heard the statement, it's kind of one of the deals with life that when you're born, you pretty much know you're going to be seeing your parents pass, but like no parent should have to see their child pass or something. So,
right.
And I imagine too, I know you said work may give, and this is generous, work may give up to 2 months. But if if it's not a sudden thing, if there's things leading up to it, hospital visits, that, it could be way more time before it even happens. So yeah,
Right.
The fact that a year may sound long, but I can't even imagine what could happen.
And I'll be honest, most of the parents that I speak with choose to go with longer than a year if they can afford it and it makes sense, just because if they're truly being honest with themselves and putting themselves in that mindset of, okay, I have a child and they just passed away, and you're really trying to put your mindset through it, it's usually a meeting that's filled with tears and emotion because you're thinking about something that you hope never has to happen.
Yep.
And almost always they say a year would not be enough. No. A year would not be enough. And so typically, if we do the calculation based on not taking into account taxes and not taking into stuff, that year worth of income replacement that we're doing could span to, a year and a quarter, year and a half, might be able to buy us wiggle room. But that's where I say, a year is usually our minimum calculation.
Yeah.
What almost every parent does agree with is that at a year is the absolute minimum.
Yeah.
That I would be able to go back to work. At 6 months, I'm not going back to work. Maternity leave is usually 3 to 6 months. You have a baby, you have the baby, and then you go back to work 3 to 6 months afterwards. And that's not even healing from an emotional trauma. That's just healing from the physical and adjusting to life and all those components. So the idea of going back to work after losing a loved one in 6 months is unheard of and just doesn't seem like the right approach. So then you have the 12-month mark. That seems like, okay, I could probably start to have the healing process and then start to look at taking those next steps. But there are limitations on this. So in order for you to have a juvenile policy, you have to have at minimum that amount of life insurance on the parents. And each company fluctuates on this, but the parents have to be insured, or at least I have had it happen where a parent is uninsurable. But we send in the application, that application.
Health reasons or?
Health reasons,
okay.
Yeah. So uninsurable for health reasons. So they get denied, and then it's allowed because you've at least tried. It's not that you don't have life insurance because you don't want it. It's because you can't get it.
Yeah.
There's ways around that, and that's where working with a professional who has experience with it allows you to be able to have those conversations. But you have to have life insurance on the parents, and there's a minimum threshold with each company on how much of a gap has to exist between the life insurance on the kids and the life insurance on the parents.
Okay.
So, and that's just because if you're going to insure the kids and you understand the risks associated with a child passing away early, more likely is a parent passing away early. And so if you're not going to insure that risk, why are you insuring the child passing away early? That really doesn't make sense.
No.
And so you also run into a fraud issue. It's as crazy as this may sound, but if you have parents that are just insuring their kids, not insuring themselves.
Oh, that was my first thought.
the parents look at, if you have an abusive household and, they're able to get through the whole process and they, pull a smoke screen in front of everybody and get the child insured, and then they end up taking that child's life, you now have, a massive fraud scenario. And I
have to say that wasn't my first thought. That's crazy. I was just thinking if everyone was in on it. It seems like an easy thing not easy, but it seems like a thing people might try and do.
What do you mean everybody in on it?
Like the child is in on it too, so they would fake death. Actually doing the death.
Fake a death.
Actually doing it would be, I guess both are crazy, but.
Yeah, fake a death I've never actually seen.
But you've seen the other?
There's cases out there where it's happened. I personally have not had to deal with it, but there are cases where it's happened, and it's where a lot of that regulation comes from, is that you can't get life insurance on your kids if you don't have it on yourself because of that. Because unfortunately, there's sick people in this world, and they'll do anything to make a buck. Yeah.
All right. Well, I got a question then. So, ideally, you're probably working with clients well before they have kids. So I guess we'll use that scenario. Are you bringing this conversation up when they tell you, hey, we're planning to have a kid, when they've already had the kid? I imagine the sooner the better, but what happens also if you meet someone who already had a kid? Like, when does this usually pop up?
So the scenario doesn't so much matter as far as like executing on this and getting a policy in place, whether you have kids, don't have kids. I would say more often than not, because life insurance is misunderstood, it's a scenario where, the kid's already, 6, 7, 8, 9, 10, and we're having this conversation, and then we're putting life insurance on the parents because they don't have life insurance, and we're putting it on the child. But there are scenarios where we have the parents insured already, and then they get pregnant, and so now we're having the conversation of when this child's born, we should do this and have this plan together, and so we start talking about it that way. And there's ways, if you understand life insurance, there are ways, if you have a child that's born with a birth defect, that child will be uninsurable until age 18. It's guaranteed. The child will be uninsurable. The way around that is if the agent knows that ahead of time. So say the child's already born. Obviously, you don't know that ahead of time if they haven't been born yet. If the child has been born and you know that they had a birth defect, what you should do is put the policy in place on the parents first. So instead of submitting everything at the same time, put the policy on the parents in place first with a child term rider. So that puts a child term rider puts life insurance on the children with no
the parents,
no questions about. There's no looking at the insurability of the child.
Okay.
And that rider is convertible, which means once that rider is in place, you can then convert that rider into a whole life policy on the child. So if you know they wouldn't be able to get life insurance, but you're able to put a $25,000 rider on the policy, you can now take that rider, turn it into $25,000 of life insurance on the child.
Nice.
Now, $25,000 is not going to replace a year of income, but you're not going to be able to get to that level of insurability on a child that's had a birth defect. And so what we're doing here is we're putting us into best case scenario. We're getting as much as we possibly can so that we can cover as much of a financial expense as we can and buy ourselves as much time if that scenario were to ever happen.
Yeah.
But if you do it the other way, if you submit everything at the same time, the child gets denied, the company can deny you that child term rider and you won't have this conversion option.
Yeah.
Because part of the conversion is going to ask you, has the child ever been denied life insurance? And you legally, it's fraud if you say no. Yeah. It's not fraud if you know as an agent that the child would not have been approved for life insurance, but they've never been denied by a company. It's not fraud to answer the question, has a company ever denied them with life insurance? That's no, because the company has not. You've just evaluated the risk and said that they most likely would not be eligible. This is the better route to go.
Right. Another thing I thought of too is obviously we went over huge reasons why to get it, probably the most important reason. But are there any also cool, but like effects that if a child gets this when they turn 18, the plan can kind of roll over?
So we've, like you said, we've talked about the primary reasons. I typically, given the time horizon of the child and statistical probability that they're not going to pass away, I usually use an indexed universal life policy on them. And the reason being is that the cash value in the policy can be tied to the stock market. So we've talked about indexed universal life in previous podcasts. So go check that out if you want to learn more about this. But it allows for more upside potential. So you're able to get more interest on that. So effectively what you can do with this juvenile policy is you can treat it like a 529 college savings plan, where you're putting money in there. When they turn 18, you can transfer the ownership to the child. The child now owns the policy, and they can take a loan out, which makes it none of the gains are taxable. They can take a loan out against the policy instead of going to the bank for a student loan, take a loan out against the policy to pay for some of their college or all of their college if you've really overfunded it tremendously. Now, the benefit to this strategy versus a 529 plan is 529 plans can only be used for college. If your child decides to go into the trades, decides to not go to college, decides to start their own business, decides to go into the family business and not go to college, any scenario where the child's not going to college, that 529 plan is going to be penalized for that. This plan isn't, because it's not a 529 plan. It's not set aside specifically for college. That money is set aside for whatever you want it to be. They could sit there. They could go get a apprenticeship, become a plumber, and then 5 years in, they're 23 to 25. They want to buy their own house because now they're making good money. They could borrow against this policy for the down payment for their house.
That's a no-brainer then with everything.
Yeah, and that's where you need a professional who knows what they're doing to structure all these things properly and have that conversation with you to say what makes the most sense, what's the best plan for this. Because effectively what you do, if you structure it properly, you can have it where it's a policy that takes care of, and from ages 6 months to 18, it's a policy that would replace your income as a parent if something were to ever happen so that you can grieve and mourn. The minute they turn 18, you can transfer ownership, or you could retain ownership and maintain yourself as the beneficiary. That part really doesn't matter. There's nuances to why we would or wouldn't do that. But the money can be distributed from the account tax-free in the form of a loan to the child for starting a business, buying a house, going to college, buying their first car, any of these sorts of major capital expenses.
Yeah.
And so it's not like we're just buying life insurance for a plan that's really only good from ages 6 months to 18. Once they once they get to their 18th birthday, we can flip this and now use it as a financial stronghold that we've developed for the child.
No, that sounds like one thought I've always had is it's always tough to imagine when you're having a child and all the new expenses there to also start a fund for them. But obviously the earlier, the better. And that just seems like a foolproof way of tons of protection, because you're getting life insurance for, many people might come back at you and say, a very unlikely thing, which it is statistically unlikely, but terrible if it happens. But then that argument completely goes out the window if structured properly, because that sets up, I'm sure most people at 18 are not set up that well. If
No.
So that's cool.
Yeah, if it's structured properly, you can do it. And the other nice part about using an index universal life policy is that the premium on that policy is variable. So like you said, if we're having this conversation with a newborn, expenses are high, you're trying to balance your budget, you're trying to figure out all of these things. You could start with a minimum premium policy and pay the minimum to have just that pure life insurance. We're looking for the death benefit option. Start with the minimum. But then there's also structuring it properly. We want to put as much money in there as possible. So there's a max that you can put in order to maintain all your tax benefits. So we can start at a minimum to maintain your budget. And then as you get raises through work and you start to balance out, getting used to having a child, that budget starts to work out properly. You can now increase. You don't have to go minimum to max. You can slowly increase. We can make adjustments, but you can change that premium so that you're putting more into it, so that you're achieving some of these longer term financial objectives to the policy. Other big part to note on this is, again, if it's structured properly, you putting in that extra money, some people get wary about that because they're like, well, I'm going to put in the extra money and my death benefit's going to be the same. So if the child does pass away, I've paid more than I needed to, and I'm still getting the same amount, but paying more. If it's structured properly, that's not true. Your life insurance will maintain the same amount, and then your cash value in the policy will be added to that. So you'll get both the cash value and the death benefit back.
Mm-hmm. Sweet.
But again, it's got to be structured properly.
Yeah. Thanks for listening to our podcast.
We hope this helps you on your balance freedom journey.
Please share your thoughts in the comments section below.
Until next time, stay balanced.